Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly review for the week ending December 1st, 2023. So December is upon us now. Let's look at this week's markets at the close on Thursday. Positive week for bonds. Positive territory for the year, 3%. There's only 1 month left. You'll always have a few surprises, but we are in good shape to end the year with positive returns for bonds. We've had strong momentum recently, so good news there. More of a mixed bag on equities. The TSX slightly higher around the world. It was more mixed. Price of oil slightly higher. There was some confusion, maybe a letdown this week. The OPEC Plus decision to extend some cuts was seen as confusing, as not satisfying for the market. So we do end up with small gain on the week. Let's see if this can keep a floor underneath oil prices. But it was a bit of a letdown this week. The decision that we had to add a few 1,000 barrels a day of cuts. So anyway, so it was a letdown for the market, but let's see if markets react positively over the next few weeks. Sometimes the reaction can be delayed here. The CAD was a bit higher, euro lower. Price of gold up about 2% on the week. Some good momentum recently for the price of gold following a very volatile November where we went from 2000 to 1950 to 2000 again. Now we're at 2036. USD seems to have peaked, at least in the short run. Real rates, and we particularly look at the 5-year real rates in the US, seem also to have peaked. Usually that helps blow a win in the sales of gold. So we're keeping a keen eye here on the price of gold. Maybe looking at Canadian data. So let's start with the GDP figures that came out early this week. Here you have two charts. On the left, you have real GDP growth quarterly, and on the right, you have real GDP growth per capita. Okay. On the left, you see that, negative for Q3. There was a sharp revision to Q2. It used to be a negative print, a very minus 0.1, was revised higher by about 1%. But the expectations for Q3 were also for a small negative number, and we got a deeper negative number. So revisions at play here. If you just average both quarters, you end up, pretty much stalling here in the on the Canadian economy. It's not a recession yet. If you look at that, usually the technical definition is 2 consecutive negative quarters. You also need to look at the unemployment rate and all of these things. So I mentioned that in the past, but if you look at per capita data on the right, because population growth is so strong in Canada, so how much goods and services are produced or consumed or traded in the economy per capita, then you see that 4 of the last 5 quarters were negative, and they're pretty deep negative readings here. So this is why you see in the paper news that some stores are having some issues. The Canadian, the CFIB, the Federation of Independent Businesses, are reporting that more than 50% of their members are struggling with their sales. Stuff like that, because we are seeing lots of inflow in the economy from demography. But if you look at on the average consumer, meaning that every sector of the economy is different here, whether it's discretionary, non-discretionary, you're starting to see some pockets of weakness that sound like a recession. And the Bank of Canada, in fact, decided to go with an analysis that includes per capita figures in its monetary policy reports recently, starting to look at that. It's a difficult picture for a central banker when you have such strong demographic growth at a moment where you're trying to put the brakes on the economy to bring inflation back. We looked at the quarterly figures here. If you look at the year-over-year figures, well, on the left, you see that we're still growing the economy on a year-over-year basis, chart on the left. But if you look on the right, well, now if you adjust per capita, well, we're 2% under where we were last year. So the average wealth, let's say, in the economy is being hurt. So not an easy picture. The focus of the Bank of Canada has been on the labor market for a while. Back in February, Governor McClem made a speech saying that as long as wage growth remains between 4 and 5%, they say that the labor market would not be consistent with inflationary pressures getting back to inflation getting back to the 1 to 3% range. And here's the picture for the week. On the right, you see that, we just had the latest labor report and we're stuck at 5% growth on wages. So we don't have this condition yet. So the Bank of Canada should stay on the sidelines for a while until, the tightening of monetary policy continues to make its way into the labor market. On the left, you see that we did create 25,000 jobs on the month in November, but the working age population grew at a faster pace than this, about 35,000 strong. So we are not seeing layoffs yet, but we're seeing a labor market that is not able to create enough jobs for the population growth, which pushes the unemployment rate up, and now we're at 5.8% on the unemployment rate. That's a rise of about close to 1% over the last year. So a difficult situation here. We still think that the Bank of Canada will stay on the sidelines, keep rates higher for longer until we do see some progress here on the labor market. Maybe some cuts. Some cuts in 2024. We still think that's going to be the case. Maybe early in the second half of the year, more probably maybe later in the year, but it's going to be depending on the data flow that we get until then. But spotlight on the labor market. If you look at the monetary policy around the world and we start to look at 2024, we think that the ECB should start cutting first. We are expecting rate cuts from from the Bank of Canada, the Fed, and the ECB in multiple developed markets, central banks in 2024. But the ECB could be first here. So maybe this chart here showing how synchronized monetary policy has been around the world during the pandemic and in the post-pandemic era. So low for everyone, and then everyone raising the rates together. When you look at other periods, you see that there were some similarities for some countries, but generally everyone had their own monetary policy. When you look at the inflation situation in Europe now, on the next chart, we see that inflation is falling very quickly. Now we're at about 2.5% for total. Core inflation is also falling strongly. This is the chart on the left. And if you look at what markets are expecting for the future, you look at the five-year break-evens here, you see that expectations in the US and in Europe were pretty much correlated for most of the year. But now we're starting to have a signal from the markets that monetary policy is tight enough that we're revising very quickly, lower the expectations for inflation. So this is sending a signal that markets are thinking that monetary policy in Europe is much more restrictive than elsewhere in the world, maybe a bit too restrictive. And inflation is falling very quickly. Inflation expectations also. There are a few reasons for that. On the next chart here, you know that Europe and China have very close commercial ties. And now China is the biggest trade partner for Europe. And China now, the chart on the left, this is the PPI, Producer Price Index, and the CPI. But you're seeing that the PPI is contracting year over year. So there's deflation in China on the prices that producers are charging. So that means that if you're a commercial partner with China, China is de facto exporting deflation to you. So this is helping pushing the inflation rate in Europe lower very quickly, and that explains why we've seen this behavior of inflation figures recently. But also, if you want to go more structural, on the right, we do know, and we already knew that before the pandemic, that working age population in Europe is declining, it's contracting. So you have Germany and Italy in this chart here on the right, but if you look at Europe as a whole, we are seeing working age population decline. So there's less tailwinds for this economy. It's a more fragile one. Monetary policy by the ECB seems to be mighty restrictive now compared to what it could be in Canada and in the US because of this, let's say, softer foundation coming from demography. So rate cuts are coming in 2024. We'll hear about them through the year. Likely the ECB will be the one to get moving first. So what to watch next week? Bloomberg Nanas Confidence Index has been declining recently. The Bank of Canada rate decision, no change is expected. Let's see how they comment the recent deterioration, the acceleration of the deterioration of the GDP per capita on a quarterly basis. Building permits will be out. In the US, we'll have the ISM Services Index, non-farm payrolls, unemployment rate, and average hourly earnings. So we should continue to see jobs creation in the US. The unemployment rate has gone up by about 1% over the last year. Should take a pause here, but the wage pressures continue to be an issue at the 4%. So that wraps it up for the week. ia.ca/economy, iagam.ca/insights. Lots of material for you. Thanks for following us, and I'll see you again next week.